Hello and welcome to Weekend Trader. I'm your host, Oliver Renick, joined by Mr. Ben Lichtenstein, host of the Future Show here on the TD Ameritrade Network. Ben, this week really was all about inflation again, culminating in the highest consumer price index reading on a year-over-year basis in 40 years on Friday. So let's start there in our discussion of what happened, how important was this, and how did it fit into the overall narrative right now about what's happening with the Fed, et cetera.
Yeah, inflation, Oliver, was front and center this week, and you can understand why. I mean, last month we saw CPI come in at 30-year highs, and so a lot of anticipation into the data on Friday, but for the most part, in line with expectations. Now, again, at these elevated levels, you can understand why Fed Chair Jerome Powell kind of had to shift some of his rhetoric, his verbiage as far as addressing inflationary concerns, no longer referring to it as transitory.
Can't ignore inflation when it's going like that.
Seems
straight line up.
More of an issue that they have to contend with, but we'll talk a little bit more hopefully about some of the other central bank activity that we heard this week. It just sort of points to, depending on where you are on the globe, the amount of an issue or a big of concern it is, it really kind of depends.
Next week, we're going to hear from central banks, including the FOMC here, but some of the other big decision-making central banks from around the world. This will be the context that U.S. is not alone in inflation, but right now unique in our central bank's approach, which it seemed the market still carried with it this week. A firm dollar, even though not breaking out higher, still suggesting that there is something unique happening here with Jay Powell.
Yeah, Oliver, it's not just inflation that investors and traders are focused on. Could be the ripple effect really kind of plays into the markets ultimately and financial markets specifically. We certainly saw that in terms of, as Oliver mentioned, the U.S. dollar holding bid levels, and I've just sort of been calling it cautiously optimistic and similar to the indices in many ways. And many of the products that we watch as far as the bid activity we've seen, the trend environment which remains intact, but we're not really accelerating to the upside in the case of the dollar, the indices, many of the products we watch, rates for example, just sideways, kind of in a bit of a holding pattern, and you can understand why when you have scientists, health officials in a bit of a wait and see mode in terms of the severity and the impact that the Omicron variant's going to have on the economy. Well, you can see why traders and investors are in a bit of a wait and see mode as well.
Started off the week just gangbusters with the stock market, NASDAQ, Russell, everything rallying, but it was the small caps then that faltered again. To your point, another really important chart that is range bound right now and still stuck, basically, the small caps in a trading area that stretches back to February. So the Russell still giving bulls a little bit of complications, even as the NASDAQ was able to get right back towards those highs just below.
Yeah, a little bit less enthusiastic relative to what we saw from the other three major indices, but the ES, for example, some 50 points roughly off the all-time highs. We're kind of just close, teetering around 4,700. So yes, very close. And again, to the point a minute ago, losing some of the momentum to the upside, but not necessarily rejecting the trend environment that we've been in. And I think that could continue as long as we see this transparent Fed. We see a very supportive environment from low rates, historically low rates, and well, some of the other contributing factors. One being investors' willingness to kind of shrug off some of the negative news from headlines, focus on the positives from earnings, and really just, again, kind of discount some of what they don't want to hear.
Yeah. What's so tricky about this moment right now is that it seems that we understand the status of the inflationary situation as the numbers on Friday were in line with the estimates, but then we had President Biden with the statement earlier on in the week saying that, hey, even though numbers are high, some of them have cooled off. We're looking for energy to start to cool off. But does that change anything from what Powell told us the week prior, right? And that's where next week is so important, because it seems like right now we should assume he's generally going to elaborate and the team around him going to tell us how they feel for hikes next year and watching that dot plot to see how many they put on the radar, because the market's pricing in 3 right now.
Yeah, I would not by any means indicate that they're on autopilot, though, at this point. I think the Fed's been pretty clear. I mean, considering some of the circumstances that they're being forced to deal with as far as impact from the new variant on the economy. And again, we even heard most recently this week from the EIA and their short-term energy outlook. They didn't seem very bullish as far as demand and some of what you would look to see to really fuel that fire to the upside as far as strong economic conditions. And, actually it was the BOC, actually, they made some comments about how they do see considerable momentum into the fourth quarter. But to be clear, I think everybody's well aware of the fact that that could change at a rapid rate depending on what plays out here. So it just really speaks to their need and ability to be kind of, on their toes, simply put.
The on the toes, which is distinctly not asleep at the wheel. And some folks had described the Fed as doing that type of approach, just kind of letting things afloat in the direction of least resistance. Earlier in the year with the average inflation targeting, they kind of made it seem like they were going to be able to just kind of hover. Now they're not. They're pushing back. It does seem like that has an effect. This week we saw more downside on the down days. When we had down days, we had companies that don't make money suffering. We had tech companies that are expensive. When we had a little bit of drop on Thursday, that's the stuff that was getting hit. Bitcoin failing also to really bounce back. So it does seem like risk assets are starting to, on the margin, respond to this. Just maybe not the broader index, where you still have Apple sitting at highs, really doing a lot of legwork there.
Yeah, I mean, depending on which kind of nook and cranny of the market that you're looking at, as I mentioned earlier, this kind of cautiously optimistic tone where investors seem still willing to participate, but maybe not as aggressively as we had seen in weeks past. And you can understand why. I mean, you're looking at some of the risk assets that Oliver just mentioned, like Bitcoin back below 50,000 this week, and kind of in a bit of a range, sort of losing some of that strength, that momentum.
Did not take part in the big stock bounce.
Sure didn't. And reminiscent of what we've seen in terms of the Russell rates and some of the other products, gold, for example, sideways. So again, sort of hinting that we're in a bit of a wait and see mode. And keep in mind, we're headed into the holiday season right now, where oftentimes you see sort of low volume, limited participation already. So we could hold these levels into the holidays quite easily if Fed Chair Jerome Powell doesn't shake things up too much. The retail sales next week and some of the data due out doesn't really surprise investors or create much concern.
All right, well, consumer sentiment on Friday coming in ahead of expectations, maybe a nice setup for next week on the retail sales. Ben, thanks for the wrap and the look ahead. Ben Lichtenstein, host on the Ameritrade Network, myself as well, Oliver Renick. Thank you for joining Weekend Trader.